Welcome back to Boss Economics World, the only show that calls out the economic clownery of governments, central banks, and corporate fat cats with zero apologies. I'm your host, the Boss Economist, here to break down the latest economic dumpster fire and tell you why your wallet's getting lighter while the suits in power keep fumbling the bag. Today, we're diving headfirst into the leveraged finance meltdown, the tariff tantrum of the century, and, surprise, surprise, how government mismanagement is shoving us straight into the jaws of a recession. Buckle up, folks, this one's gonna hurt. Alright, let's get into it. If you've been paying attention to the financial markets lately, or, just trying to survive in this inflation-ravaged, debt-soaked economy, you've probably noticed things are looking a little apocalyptic. Deals in leveraged finance are stalling faster than a government budget negotiation, markets are flipping upside down, and banks, they're sweating bullets, terrified they'll be stuck holding billions in toxic debt they can't offload. And who's to blame for this mess? Spoiler alert, it's not market forces or bad luck. It's the catastrophic mismanagement of economic policy, led by none other than our tariff-touting, recession-baiting policymakers. Let's unpack this hot mess, layer by layer, and figure out what it means for you, me, and the poor schlubs on Wall Street who thought they could outsmart the system. First up, let's talk about the elephant in the room, or should I say, the tariff tsunami crashing over the global economy. Last week, former and maybe future US President Donald Trump dropped a bombshell, the steepest American tariffs in a century. We're talking about trade taxes so aggressive, they make the Smoot-Hawley Tariff Act of 1930 look like a friendly handshake. For those of you who slept through history class, Smoot-Hawley triggered a global trade war, deepened the Great Depression, and basically turned the 1930s into an economic horror show. So, naturally, our fearless leaders thought, hey, let's run that playbook again. Here's the deal, folks, tariffs are taxes. And taxes don't just magically disappear into the ether, they hit businesses, consumers, and markets like a sledgehammer. According to the Peterson Institute for International Economics, Trump's proposed tariffs could slap a 20% tax on all U.S. imports, with even higher rates, up to 60%, on goods from China. The Tax Foundation estimates this would cost the average American household $2,600 a year in higher prices. That's right, folks, your grocery bill, your car parts, your kids' toys. All going up, 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 while your wages stay flat as a pancake. But it's not just consumers getting burned. Businesses, especially those in leveraged finance, are getting absolutely torched. Take the case of ABC Technologies Holdings Incorporated, a Canadian auto parts maker trying to buy TI Fluid Systems plc. Their financing deal delayed. Why? Because investors are running for the hills, spooked by the tariff-induced market chaos. Same story with HIG Capital's bid for Converge Technology Solutions, a Canadian software provider. Their $900 million leveraged loan sale dead in the water. Banks like Citigroup and JP Chase are staring down an April 2025 deadline to close these deals, but with markets in freefall, they're more likely to be stuck with hung debt, toxic loans they can't sell, than to find willing buyers. And let's not forget the ripple effects. The S&P Global Market Intelligence reported that new issuance of junk debt in the U.S. has ground to a halt, literally, just one new high-yield bond and zero leveraged loan launches in the past 6 trading sessions. Why? Because investors aren't stupid. As Jeremy Burton from PineBridge Investments put it, why commit a bunch of new capital in front of risk? Exactly, Jeremy. Why indeed, when the government is playing economic Russian roulette with tariffs? Now, let's zoom in on the leveraged finance market, because this, folks, is where the real carnage is happening. Leveraged finance is like the Wild West of Wall Street, high risk, high reward, and absolutely zero chill. It's where banks lend billions to fund corporate acquisitions, private equity buyouts, and other big money deals, then sell that debt to investors to get it off their books. But here's the kicker, when markets get shaky, those deals stall, and banks get stuck holding the bag. And right now, the market isn't just shaky, it's a full-on earthquake. Take the ABC Technologies deal. Banks committed billions to finance the acquisition, but with tariffs jacking up costs for auto parts makers and recession fears tanking investor confidence, nobody wants to touch that debt. Same story with HIG Capital's deal, Bank of Montreal couldn't drum up enough investor support, and the deadline passed without a sale. And it's not just these deals. Efforts to refinance $660 million of junk debt for Chuck E. Cheese owner CEC Entertainment failed. A $5 billion private credit loan refinance for Finastra Group Holdings kaput. This isn't just a blip, folks, this is a systemic meltdown. Why is this happening? Well, let's connect the dots. Tariffs are driving up costs for businesses, especially those in consumer-facing or manufacturing sectors. Higher costs mean lower profits, which means those companies are riskier bets for investors. At the same time, the Federal Reserve has been hiking interest rates to fight inflation. Rates are now at a 23-year high of 5.25% to 5.5%, according to the Fed's latest data. Higher rates make borrowing more expensive, which squeezes leveraged companies even further. And to top it all off, recession fears are making investors skittish, so they're pulling back from junk bonds and leveraged loans faster than you can say, subprime mortgage crisis. Here's a fun fact to chew on. According to Bloomberg, the total volume of hung debt on bank balance sheets is now at its highest level since the 2008 financial crisis. That's right, folks, we're talking about tens of billions of dollars in toxic loans that banks can't offload. And if those loans default, guess who's on the hook? Not just the banks, but the entire financial system. Remember 2008? Yeah, this is starting to feel eerily familiar. Now, let's get to the juicy part. Who's to blame for this mess? Spoiler alert, it's not the invisible hand of the market. It's the very visible, very clumsy hand of government mismanagement. First, let's talk about tariffs. Trump's tariff tantrum isn't just bad policy, it's economic sabotage. The National Bureau of Economic Research found that the 2018-2019 tariffs cost U.S. businesses and consumers $40 billion a year in higher prices, while tanking U.S. exports by 11%. And that was just the warm-up act. This new round of tariffs could be even worse, with the International Monetary Fund warning that global GDP could shrink by 0.8%, or $700 billion, by 2026 if trade tensions escalate further. But it's not just tariffs. The Federal Reserve deserves a big, fat F on its report card too. For years, the Fed kept interest rates at rock-bottom levels, flooding the market with cheap money and inflating asset bubbles from stocks to real estate to leveraged finance. Then, when inflation finally reared its ugly head, reaching a 40-year high of 9.1% in June 2022, per the Bureau of Labor Statistics, the Fed panicked and slammed on the rate hike brakes. The result? A whiplash effect that's crushing businesses, consumers, and markets alike. And let's not forget Congress, which spent trillions on pandemic stimulus, $6 trillion, to be exact, according to the Committee for a Responsible Federal Budget, without a coherent plan to manage the inflationary fallout. Here's the kicker, folks, none of this is an accident. It's the predictable result of policymakers prioritizing short-term political wins over long-term economic stability. Tariffs. Great for rallying the base, terrible for the economy. Rate hikes. Great for looking tough on inflation, terrible for businesses and consumers. Stimulus spending. Great for buying votes, terrible for fiscal sustainability. And now, here we are, staring down the barrel of a recession, with leveraged finance markets in chaos, banks on the brink, and ordinary people getting squeezed from every angle. Now, let's take a quick detour across the pond, because Europe's leveraged finance markets are, surprise, surprise, holding up better than the US. Take the €7.45 billion debt sale to fund Clayton Dubilier and Rice's purchase of a stake in Sanofi SA's consumer health division. That deal went off without a hitch, priced in line with expectations, even as US markets were imploding. Why? Because Europe hasn't been hit by the same tariff shockwave, yet. The European Central Bank has also been more cautious with rate hikes, keeping borrowing costs lower than in the US. But don't get too cocky, Europe. If Trump's tariffs spark a global trade war, nobody's safe. The World Trade Organization estimates that a full-blown trade war could slash global trade volumes by 17%, hitting export-heavy economies like Germany and France hard. So, enjoy your moment in the sun, Europe, but the storm's coming. So, what's the takeaway, folks? For ordinary people, this mess means higher prices, tighter budgets, and a whole lot of economic pain. For finance pros, it means a leveraged finance market on life support, with deals stalling, debt piling up, and banks sweating bullets. And for the economy as a whole? It means we're on a collision course with a recession, thanks to a toxic cocktail of tariffs, rate hikes, and government mismanagement. But hey, don't take my word for it, just look at the data. The Conference Board's leading economic index has been flashing recession warnings for months, with a 70% probability of a downturn by mid-2025. The Institute for Supply Management's manufacturing index is in contraction territory, signaling a slowdown in industrial activity. And consumer confidence? According to the University of Michigan, it's at its lowest level since the pandemic, as Americans brace for higher prices and lower growth. Here's my advice, folks, buckle up, because this ride's about to get bumpy. And to our fearless leaders in Washington. Maybe, just maybe, it's time to stop playing economic roulette with our livelihoods. But hey, what do I know, I'm just the boss economist, here to call it like I see it. That's all for today, folks. If you liked this video, smash that like button, subscribe, and ring the bell so you never miss an episode of Boss Economics World. And let me know in the comments, what do you think of this tariff tantrum, and who do you blame for the leveraged finance meltdown? Until next time, stay savvy, stay skeptical, and stay tuned.